I had a client that was hosting a beautiful dinner party. She had a beautiful patio, and she thought it would be a good idea to throw a bunch of tea lights in the pool for ambiance. It looked gorgeous, right?
Of course.
It's
Yeah,
dusk,
I can only imagine.
sun is going down, and you've got this gorgeous patio. And it looked really pretty for a couple of hours, but what happened after a couple of hours is that the tea lights started getting caught in the pool filter system,
That's what I was
and
thinking.
it caused a mini explosion.
Oh, no.
Damaging the pool, causing about $180,000 worth of damage, right? That was sudden and immediate. The pool filter system did not malfunction due to wear and tear. That's something that in a traditional State Farm policy, if you will, would not have been covered, or maybe only had a $5,000 sublimit.
Welcome to Planning Reimagined, a podcast from the planning experts at Robin Glen and RX Investment Partners for wealthy families and successful business owners.
Hi, I'm Celeste Moya. Welcome to another episode of Planning Reimagined. Today's episode is part of a series that's focused on family offices, which are the financial nerve center for affluent families. And many times we think of a family office and we think of wealth management, investment management, maybe some estate planning, but they also play a vital role in risk management. However, many times they're concealed behind a mystery. Family offices are kind of like the Fort Knox for wealthy families. So today, join us to take a sneak peek behind the curtain of how they handle insurance and how they use it not just to protect, but also to perpetuate legacies. So today we have with us Yadira Ansueto. She's with K&S Insurance. She's a very seasoned advisor, over 20 years, focused in the risk management space, specifically for wealthy and affluent clients. So thank you so much, Yadira, for joining us. I know that you have a wealth of knowledge and expertise in this space. We really appreciate you being with us today.
Yeah, thank you for having me. I've been enjoying the podcast so far. So
thank you. We appreciate that. So we'll just, jump right into it. So all of us have probably seen Flo with the Progressive and Jake from State Farm, but, they make insurance seem more like a sitcom these days, or see what celebrity they can add in versus the reality of what it actually does, right? But really, when your practical mode of transport is more like a jet, those traditional type of companies are probably not going to cut it from a risk management insurance perspective. And that's what we see a lot with our clients. With them, it goes way beyond just safeguarding that vacation home, that luxury car, because now we truly are preserving legacies. It goes far beyond just traditional risk management. So we want to talk about those solutions that are adequate to actually protect what these types of clients own, which is many times unique and different than maybe the traditional consumer. So before we start with that, though, for our audience or our listeners that aren't familiar with a family office, can you just provide a very high-level explanation of what is a family office for wealthy families?
Sure. So very high level, what a family office is, it's a professional office that a family will set up or engage another advisor to set up for them. Typically, it happens around the $50 million to $100 million wealth threshold, where they maybe have acquired a few different homes, maybe a watercraft or a yacht, some jets or different recreational vehicles, and things are starting to get out of hand, especially with bill pay. Bill pay is one of the first areas that we see clients not paying their premiums, or they forgot to pay the phone bill, things like that. And so although a family office is initially set up to help manage wealth, to grow and preserve the wealth management piece is probably the first thing that they think of, but they don't realize that a family office can help in so many different areas. And lifestyle management, in my opinion, is always a key essential part of the family office, helping them with things that they may not realize are falling through the cracks, and then helping them, in essence, just run a family enterprise for the family, right? And just set it up correctly so that it's done well. They're doing life well, right? Yeah.
I think that's a perfect way to put it, a family enterprise. And I mean, even in our day today, both of us are busy, working moms. There's things that fall through the cracks. I forgot today that my daughter didn't have school, and now we're, at the last minute trying to find somebody to watch her. So it's things like that. And these families have much bigger problems than that. And you're right. They're busy growing their businesses. Many times they may have multiple businesses, multiple entities, a lot of things happening. They're traveling around the world. So having that center those folks that are really helping them manage their life in all aspects of life, even the little things to the big things. So that's a great explanation of it.
Yeah, and I think before they hit that threshold where they're thinking about starting a family office, sometimes the wealth management team will serve as that quarterback that brings in all the other advisors that family may need. But you're right. They're running businesses. They have families. They're vacationing, doing the things that they want to do to enjoy their life. And a lot of the times what I see is a lot of families are now looking towards a family office solution because they're actually first-generation wealth. Mm-hmm. And this is not something that they're used to doing. They haven't lived this life before. Their parents didn't live this life. And so they don't have that experience. And so setting up a family office is the perfect way to get things in order, get things organized, manage risk, grow the wealth, preserve the wealth, and, do things more efficiently. So,
and we won't go into super detail on this because we're going to talk about it in some of our other episodes. Mm-hmm. But just to add something, if you're not quite at that threshold level, but you're still wealthy, there's other solutions like multifamily offices, which are organizations or companies that focus specifically on several families that maybe don't need what a 50, 100, billion-dollar family needs, but still have those needs because they're in the middle, maybe even more because they're in the middle of growing this enterprise.
Right, maybe even more. And I'll say one last thing about this is I have been seeing advisors pop up that they almost operate like a multifamily office, but they come and they work with the families on a project basis. So if the client wants to set up an efficient way to pay bills or has some estate planning needs or some tax implications that they don't know how to navigate, they will engage this multifamily office consultant that will help on a project basis, get those things set up for them, and then move on and continue doing things with their traditional team. So they're getting pretty creative. And I think now in 2024, there is a lot of emerging wealth. And so it's important to have those solutions there for the families. But
yeah, absolutely. Yep. That's a great point. And we fortunately have resources in that space. So they can always, our audience viewers can reach out to us and we can connect them with folks to do that if that's something that they need. Absolutely. So now let's talk about safeguarding what the real conversation is about today, safeguarding those assets. Most of them have unique assets. We've all seen maybe some athletes out there that insure body parts. We have singers that insure their vocal cords, and those might be on the extreme basis. But many of our clients have valuables that are different, and they're also being faced with different types of threats that they didn't face before. Cyber threats is an example of something that they weren't dealing with before. So how are you and your team crafting insurance strategies that are unique so they can actually protect these assets?
There are a couple of different ways. So one of the ways that we look at families that maybe have multiple state properties, which most do, is we will look at options to optimize the premium that they're paying, put together the most customized plan for them. And so as an example, I'll use a client that we currently are working with. He has 5 different properties spread across the U.S., and very high-end, high-value homes, but they're all in different parts of the country. Well, that's a really great place to start because traditional insurance might place you with individual policies for each property, but what we've done for this family and what we're currently working on putting together for them is maybe thinking outside of the box. Maybe a property limit policy works best for them. And the reason why that's a really great and innovative idea, maybe not innovative, creative idea, is because, as an example, if an earthquake were to hit the West Coast, right? He has 2 homes on the West Coast. And if an earthquake hit or major catastrophic weather event had hit the West Coast, those 2 properties would be affected, but the other 3 properties in other parts of the country are not. And so what we can do, if those 5 properties total, as an example, $100 million in coverage, maybe we only write a policy for $60 or $70 million in coverage, because the thought is that all 5 homes would not be destroyed at the same time. And so we can lower the dwelling limit, and therefore maybe providing a premium savings to the client in a creative way that they hadn't thought of before. And so that is one way that we can put together something creative, optimize the program that we've put together for them. And, it's, how can I say this? It's an idea that maybe their broker hasn't brought to them before.
You can say it. The other person doesn't have the expertise. Absolutely.
It's an idea that maybe the broker has not brought to them before. Yeah. And we can do that with property coverage. We can do that with flood coverage, with earthquake coverage. In addition to that, sometimes brokers, traditional brokers will maybe offer the standard $5,000 or $10,000 deductible, for instance. Well, in the family office space, or for ultra high net worth or affluent families, they have a higher risk for tolerance, or a higher tolerance for risk. And so that means that maybe those higher deductibles are an option. And so when you bring these ideas to the client, they may or may not go with them, but at least you're coming with something different that they haven't seen before. And that is really important, not only because there are brokers out there that may not be thinking of these solutions, but you'd be surprised. With emerging wealth, I talk to families all of the time that have family office level wealth that are still with State Farm, that are still with Allstate or AAA, and they've only done insurance in the traditional way. And so this is a better way, a customized way that works for them.
Absolutely. I mean, that's a great point. We talk about this in the life insurance space, and there comes a point where you really need more of those very strategic solutions, which you just mentioned before, about being able to almost divide and conquer the different properties that they have and make it more affordable for the client. I would imagine that that's just not a capability that some of these traditional companies have. Maybe a lot of clients haven't heard. What we've come across a lot is a client grew so fast that they never even had time to think to leave that traditional broker that they've outgrown, that maybe can't support the type of assets that they have now, right? But they've just been so busy, once again, growing their business, creating this wealth, that they haven't had time to look at those things. And so that's why it's so important. And I'll emphasize this, not just because you're here, but I would say this over and over. If you are at that level of wealth, if you have those type of assets, you have to go with somebody that understands how to insure them. I can imagine there's even other problems with just standard policies, but we can talk about that next. It's actually like a great segue into next question that I had. So, when your garage maybe looks more like a luxury dealership, that once again, State Farm, not to pick on State Farm, all those companies are great. They all have great insurance for traditional type of insurance. But that just might not be the solution. Can you tell us, what do some of these standard policies overlook, and that could potentially be really, threatening or scary for clients?
Okay, so it's about comparing apples to oranges. And I do pick on State Farm because they're a great company. I actually spent the first 10 years of my insurance career with them, so I know that they are an excellent carrier. However, it's apples and oranges. And so what happens is that you're going from a very standard level policy that is great for a starter client that just graduated college, that just purchased their first home. As you move into the next level of luxury lifestyle, let's put it that way, there are more bells and whistles, if you will, on a product from a high net worth carrier versus State Farm that are actually not just bells and whistles. They're essential to making sure that in the event of a total loss of this high value home, they're going to have the coverage that they need to protect them. I'll tell you a funny claim story. So
we love funny stories.
Yeah. So when I meet with a client or with a family office, the first thing that I do is I will take where they are today with their current carrier and coverage limits and all of that, and I'll put it into a comparative proposal with what my recommendations are and gaps that we identified in the review process. And I tend to be a little more thorough, and it gets me every time. It tickles me because I'm a total insurance nerd, but I'll always ask the client or the advisor that I'm sitting with, would you like to go over this at a very high level, or do you want to go line by line? They always say, I want to go line by line. And so I've actually pulled out things from the policy that I think are important that will protect you at the time of loss that you maybe haven't thought of. So one of those coverages that I always go over in detail is equipment breakdown coverage. And they'll always ask, what's equipment breakdown? So it is coverage for the sudden and immediate breakdown of a mechanical home system. So think water heaters, HVAC systems, and then this funny claim story. So I had a client that was hosting a beautiful dinner party. She had a beautiful patio, and she thought it would be a good idea to throw a bunch of tea lights in the pool for ambiance. It looked gorgeous, right?
Of course.
It's
Yeah,
dusk,
I can only imagine.
sun is going down, and you've got this gorgeous patio. And it looked really pretty for a couple of hours, but what happened after a couple of hours is that the tea lights started getting caught in the pool filter system,
That's what I was
and
thinking.
it caused a mini explosion.
Oh, no.
Damaging the pool, causing about $180,000 worth of damage, right? That was sudden and immediate. The pool filter system did not malfunction due to wear and tear. And so that's something that in a traditional State Farm policy, if you will, would not have been covered, or maybe only had a $5,000 sublimit. Well, when you talk to an experienced broker, we know that in the event of a sudden and immediate mechanical breakdown like that, it can lead to fire. That can damage 25% of that home. And so that client was covered under the mechanical breakdown coverage. I think they had about $250,000 in coverage, and the $180,000 was covered. So those are instances where I will sometimes hear from clients that say, oh, you know, insurance carriers are in the business of not covering claims or denying claims. And in reality, they're not. They want to cover the claim, but they tell you how they're going to cover it in the contract that oftentimes clients don't read. And so my job is to pull those different policy contract specifics out and explain how they would apply at the time of loss. And that's how we show value is, listen, this is where you are today. But if we continue down this road, things like this, claims like this may happen and you won't have coverage. And so my job is to explain them, highlight the gaps, and then show you solutions. So
Yeah, no, that's great. I mean, those
Yeah.
are things that we just don't think of.
Mhm.
When you said tea lights in the pool, having a pool, that's kind of the first thing that came to mind is, oh no, they're going to get stuck somewhere and cause a problem.
Yeah.
Our daughter has thrown things in the pool that have caused issues before, so that's why I'm very familiar with it. But you're right, those traditional policies wouldn't have that particular benefit that somebody could access. And at that level, you know, 180,000, regardless of wealth, that's still significant. And nobody wants to spend that money if you don't need to.
That's right. And then you mentioned cyber protection earlier. That's another coverage that you cannot buy on the standard market side or the direct carrier side, I will say. And that's become more and more of an issue. We have had solutions on the private client side for cyber for about 5 or 6 years now from the high net worth carriers. And they think about things that an everyday client may not think of or have exposure for. I'll tell you another quick claim story, but it's so scary to think that these things happen every single day. And having the coverage there is important, but also having somebody to advocate on your behalf at the time of the claim, right? So this is back in 2018. 2018 is the year that this happened. And so cyber coverage was becoming more and more normal to be offered at annual review time by these carriers. And they show this this claims scenario happening in real time where a client works from home. Okay. He has a secondary home office in the home, and they have a nanny. And the nanny comes in 5 days a week, watches the kids. Wife is also working, going about her business. Well, the nanny happens to go to a coffee shop. And of course, these families are targeted because of wealth and because of the assumption of deep pockets, right? So they're targeted. Maybe there's surveillance that happens for a few weeks before the attack actually happens. But the nanny goes to the coffee shop, walks in, grabs her coffee, never realizing that on her cell phone, she picked up a virus that somebody installed while she was in the coffee shop.
Wow.
So she comes back to the client's home, and she comes in as she normally does, gets the kids ready, takes them to school, comes back, and you can see her. They're tracking her through every room that she goes into the home, and she's spreading that virus. Now, she was never the target. It was that client's the client's computer where he was doing his work, right? And so now they've installed a virus on his computer, and now they're holding it for ransom, right? Those are scenarios that happen every single day. Actually, it's quite scary. And in the past, we didn't have solutions, whereas now we can obtain coverage limits up to $1 million for situations just like this. And so, it's things, again, that could happen to anyone, I'm sure, but because of the status of the family, the wealth of the family, they're targeted. And so those are other things that we see happen, and those are solutions that you can't find on the standard market.
Yeah, and people don't realize how expensive that ends up being when you do have some kind of cyber attack. I had an identity theft issue that cost a lot of money, and that I feel like still continues to be the non-gift that keeps on giving sometimes, because there's just things that keep popping up and things you have to clean up. And I can only imagine at that level the amount of money that they're spending just to be able to, one, the ransom they have to pay, but also just to clean it all up. So that's incredibly scary. Yeah. And that actually, talking about the nanny, that's a really important point. So it's not just about protecting the assets, like the properties that they have. These folks have other risks that I feel are ignored a lot from what I've seen. Obviously, I'm not in your shoes every day. You probably see it more. But with their, these lifestyles come the folks that help them with these lifestyles, like the nannies, maybe the folks that take care of their home. And if somebody in that space has an accident. So these are liability risks that are very different from just protecting an asset. So how are you helping clients mitigate those type of risks?
Yep, that's very important. That's actually where we spend most of our time, is talking about liability and how to protect your liability, because it can happen in so many different ways. Now, the examples you gave are maybe not everyday risks, but definitely can happen very easily. But I always start off with the conversation. The biggest liability risk we have is getting in the car and driving every single day, right? Accidents happen. And these families tend to have higher end vehicles, luxury vehicles even. And again, what we're protecting is the assumption of deep pockets. They hit someone, maybe they hurt someone pretty badly. The first thing that happens, or the first thing that person will think of, is if they get out of the car and they were just hit by a Bentley, I need to call a lawyer, right? Yeah. That's the first thing they think about. And so we talk about all of the different risks. And the first step to that is talking about, how do we determine what the right umbrella limit is, right? A lot of the times, clients don't even know. Now, if I'm taking them from a direct writer like a State Farm or Allstate or AAA, no one has even had that conversation with them. So the first thing right off the bat is, let's determine what the right umbrella limit is for you. In order to determine that, there's always 5 factors to think about, and they'll say, okay, what are those? So we want to think through liquid assets, money in the bank, tangible assets, the homes and the autos that we're protecting for you today, investable accounts, 401ks, retirement accounts.
Wow, yeah.
All of those things combined, along with your potential future earnings, those make up your total net worth. Now, this is typically the part of the conversation where I actually will invite them to ask the wealth manager to step in and be a part of the conversation, because the potential future earnings, that's sort of a gray area. Client will look at me and say, I don't know. I'm 45. What's my potential future earnings? Wealth managers can help you forecast that and think of what your overall net worth is. Now, as an example, if they say your overall net worth is $50 million and they have, a couple homes, maybe kids are out of the home now, they're 50 plus, their risk profile is not as high as someone that maybe is in their 40s, has some teenage drivers in the household and more risk, right? And so I would never recommend a $50 million umbrella. I would say, why don't we look at limits that would give you enough coverage to settle out of court? Should you hit somebody with that Bentley, you hurt them, and they want to sue you, let's buy enough coverage so that we could all quickly step in, mitigate that loss and settle out of court, because the moment that you get to court is where the judge may say, I want a list of all assets, liquid, intangible, and everything else. And we can no longer control what that judgment will look like, right? And so I always tell clients, let's pick a limit that makes you feel comfortable, that should the worst happen, God forbid you hit someone and they lose their life, you would still have enough coverage to settle out of court. And so it may look different to different people. Some people don't like risk at all, and so they may say, well, I'll go with a $25 million umbrella, where other clients, they know they don't go out drinking and driving. They know that they stay home most of the time, live a quiet life. They may feel comfortable with a $10 million umbrella. So it just depends, but that we have a very deep discussion on how much coverage you should have. But you're right. Claims examples of liability suits or liability exposures are things like, you have a dinner party, you serve beer and wine. Maybe somebody drinks too much. They get in their car and they drive home. On their way home, they hurt someone. The first thing that happens is the discovery part of the process, right? Where were you? Were you drinking? Who served the alcohol? The moment that they find out that they were drinking at your home, the attorney will then name the driver in the suit, the owners that held that dinner party in the suit. Then they find out that that home is owned in the name of a trust or an LLC. They'll name the entity in the suit. And so making sure that all of those parties are covered by the liability coverage that a policy provides is essential. It's key. And I would say that's maybe 90% of what I find on accounts that I review is that a lot of the times these clients are sophisticated and savvy, and they've spoken to a wealth manager, a CPA, an estate planning attorney. And a lot of the time, to shift the exposure, they'll retitle the homes into the name of a trust or an LLC to shield that asset.
Very common. Yep.
Very common, right? And the misconception is that if you shift the asset into the name of a trust or an LLC, it's covered. Nobody can touch it. I would say it depends on what state you're in, right? I speak to a lot of estate planning attorneys here in Texas, and they've tried to explain it. At the end of the day, I'm not an attorney, right? But the way that we explain it to the client is, listen, that is a great way and an extra layer of protection, but insurance should always be the first line of defense. It is the least expensive way to protect all of your assets as well as your liability. And so what happens in the scenario that I just explained is, if the client that held the dinner party was sued, husband and wife are named insureds. They would have the liability coverage that home policy and the umbrella policy provide. But if the entity was left off of those policies, the entity that holds that asset, that beautiful home, now it's sitting there exposed, uninsured, and if they're named in the suit, maybe now that asset is in jeopardy. So it's little things like that, understanding not only the dynamics of a family office or a wealthy family, but also understanding what strategies the other advisors are putting in place for them, and learning how insurance works very collaboratively with it, right?
We talk about the same thing. How does it fit in and enhance your planning?
Yeah.
And I think there's a misconception. I think you made a great point of, there's going to be a cost to it, but there's a much bigger cost if you don't plan for it. And I'm sure that, if you go look at a policy that doesn't cover your risk with a traditional company like a State Farm or a Farmers, then cost is going to be lower. But your protection is so much lower that one day, if something does happen, and there's such a high probability of things happening, it's going to cost a lot more out of pocket to fix that, or to, pay whatever is necessary to pay at that point. So I think there's that big misconception of, well, I just don't want to pay those high premiums. Well, unfortunately, if you don't pay the premium, sometimes you have to pay much, much larger sums of money to get rid of those problems in the future.
Yeah, much larger sums, but think about it from this perspective. It makes total sense for you to go with a more comprehensive high net worth carrier, because most of these affluent families, if they have a small loss, a small nuisance claim, they're probably not filing that claim, right? They had a small water leak. It cost them $5,000 to fix. They're just going to pay out of pocket. Or there was a hailstorm and the vehicle has a bunch of dents in it, right? It's going to cost them a couple $1,000s. They might not file a claim for that. So clients in this space are purchasing insurance in the event of a catastrophic loss. Can they afford it? Maybe. But do they want to pay out of pocket for it and use that money that they could be using to invest and grow their wealth on repairing the damage? No, it doesn't make sense. So it's almost like a wealth accumulation strategy, if you will.
Yeah.
I want to use the money to invest. I don't want to
Asset
use
protection.
it. Yeah, right.
Yeah,
That's exactly
absolutely.
what it is.
And I read an interesting statistic as we were just kind of preparing for today that said that 40% of wealthy individuals do not have their luxury assets properly insured, which I'm sure, once again, going back to our initial conversation, they've grown too fast. Maybe you don't have the right advisor. Don't even know that the right advisor exists until I started working more in the high net worth space. I didn't realize that on the property and casualty side, that's also a space in which you truly have a specialist like yourself that focus in that space, which is different from, just traditional use for property and casualty. But it also said something that we talk about a lot too, and it's about a review that the majority of them have not had a comprehensive review by a specialist in high net worth asset protection or property protection, maybe ever in the time that they've had these assets. So going back to where we started, that family office conversation, sometimes the folks that are leading these family offices are not family members, right? They are brought on as the CFO, COO, and they're in charge of also handling risk management, and they're not the experts there, right? So what kind of tips or practical recommendations beyond just call me, I'm here to help you, do you give family offices so that they can protect the families that they're working with?
Yes, so that's a great question. So I would say number one is let's start with the basics, right? If they've never had an insurance review, it could start by just simply saying, when was the last time they reviewed your insurance coverage? If clients work with a broker that is experienced in this space, they will say, I talk to my broker every single year, or we meet quarterly or semi-annually. They'll know how to answer that question. Most of the time, what they'll say is, I pay my policies or renewals every year. I don't know, they renew. And so that's the number one indicator. You need to have an insurance review. And I recommend that all clients, regardless of whether they are thinking about switching brokers or not, have an insurance review every 3 to 5 years. It just makes sense. In addition to that, though, annual summary meetings, discovery meetings are extremely important. So there's families that live a very low-key lifestyle. They may have some nice assets, and we've looked at everything, we've reviewed it, and it looks good. We'll talk to you next year unless there's any changes. But then there's clients that are not only in wealth accumulation mode, but they're in asset accumulation mode. They're buying high-end vehicles and vacation homes and jewelry, all sorts of things all the time.
Or they become obsessed with an artist and they're acquiring all this art.
They're traveling all over the world to find this piece of art. And so in cases like that, when I see that there's a lot of movement even during the annual or during the initial review period, I'll suggest, hey, can we meet in 3 months? I just want to make sure that we're not missing anything, that things don't fall through the gaps, things like that. Now, for the family office or the CFO, I would say that if the family has not had a review in the last 3 to 5 years, it's probably a good idea to do that. The market has changed so much, even in the last 12 months, that it's important. And if you're comfortable with your broker, but you just want a second opinion, that's also a good idea. You're entitled to do that. And I think that not doing that is probably a disservice to the family. So just making sure that you stay in contact with a broker that understands the dynamics of this family, what the space looks like and what their needs are is important. Working with advisors that also tend to work collaboratively with others, I think that's key. I always talk to advisors, attorneys, CPAs about how we make up the perfect wealth management puzzle, right? Every single client should have the 4 main components of this puzzle, which are always estate planning, tax planning, wealth management, and tangible assets or risk management insurance, right? And if you have those 4 bases covered, family will be protected and insured adequately at the time of loss. So I would say, although they are complex insurance programs for these families, there's a lot of moving parts. There's a lot of ways to get creative with their insurance solutions. The bigger the families get, or the bigger the family office gets, things get a little simpler, a little quieter.
Interesting.
They're really looking for simplified solutions that make sense. Some will be specialty products, especially for the art collections, the car collections, the yachts, of course. But they want to keep things as simple as possible. And so I would say just a broker that understands how to stay engaged, how to make sure that nothing's falling through the cracks is key. It can seem like a cumbersome process initially, right? The first thing we ask for is, please provide a copy of all of your policies and all of the driver information. Well, if there's 12 domestic staff and, a family dynasty or whatever, it can get cumbersome. But after we do that initial review, we can put you on cruise control and make sure that, even if the worst should happen, you're covered, and they feel confident in the program we put together for them.
Yeah, I think that simplicity is such a good point.
Yeah.
These clients already have a lot of complexity in
That's
their life.
exactly it. Yeah, that's exactly it. And, one of the things that I think just rings so true is clients think of insurance as that necessary evil. They don't want to think about it. They don't want to pay for it.
Yep.
But when the claim happens, they're all
So
about
happy.
it. They want to be there. They want to understand the coverage. They want to know how it will apply. And so I always say, listen, my job is to sit here and explain personal insurance in a way that makes insurance sexy again. Like, we want to make sure that you understand it and that you're confident, and that should something happen, you're covered. Where most of the time, clients can't say that. They actually think, like I said earlier, carriers are in the business of not paying out on claims, and that's just not the case. So
yeah, absolutely.
Yeah.
We hear that a lot too.
Yeah.
They're like, well, are they actually going to pay the death benefit at some point? And like, no, they really will. Especially when you have an advocate. And you said that earlier, so important, because of where we sit, where we're not representing one company, really we're representing the client. And the life insurance is different how we advocate, but for you in a claim situation, they're not doing this on their own. You're able to, or your team is able to help them navigate whatever that maybe kind of scary process of making the claim, or just a cumbersome process that they don't want to deal with. They have access to professionals who can handle it for them. It's much more concierge than, hey, call the 1-800 number and wait 40 minutes till you get the right claims person, because it's just handled differently within this type of space, in the private client space that you mentioned. So last question, are there any you would say like emerging threats that are new and that clients should be aware of, but that also have the ability to be protected with insurance?
People are quite simple. They do the same things.
Drive bad. Maybe.
Decades after decades. And so I would say maybe a resurgence in risk that I've seen is, for many years, I didn't really hear a request for kidnap and ransom coverage. And in the last 12 to 24 months, maybe because of the state of the world, really, clients have been asking for that coverage again. So just knowing that for these high profile or extremely wealthy families, kidnap and ransom coverage may make a lot of sense. They travel a lot, sometimes globally, for business, to vacation. And so that's definitely something we can help with. Another area that we didn't touch on too much, but I think is so important and goes hand in hand with the actual insurance policy, is risk management support and education for the family. So we will come in and we'll talk to clients about the cyber threat and how to protect against it. We may come in and talk to the family about kidnap and ransom, but we'll also talk to the kids about making sure they're not geocoding their locations on social media or talking about where they're at. You have Snapchat and Instagram, and these kids are, maybe showing to their friends what they're up to, but they're tagging themselves, geocoding themselves to a specific location. Well, when you're a part of a family like this, that's not a good idea. So just understanding that. We talk about domestic employees and how to prepare for when things go wrong, if they go wrong, especially with the larger families that have more robust domestic employee teams. We'll talk about risk management, employee handbooks. What is work comp versus employment practices liability? Clients are used to hearing the term employment practices liability or work comp on the commercial side, but they never think of this on the personal side. So we talk through what that is, right? Very quickly, work comp will protect the employee against injury or death while working for you, even if they're working in your home. But employment practices liability protects you against claims from, let's just say, the nanny, of racial discrimination, sexual harassment, things like that we don't normally think of. And so risk management goes hand in hand with that. And I think we don't give it all the time or attention that it deserves, but education is key. We think of educating advisors that are working with the families, but families really value that type of education as well. They just haven't thought of it.
Absolutely. Especially the next generation who are on all those social media platforms and don't realize the exposure. And they do it, kind of, they don't mean harm. They just do it because they're just sharing with their friends. It's what they do every day on social media, right? Mm-hmm. We were with some friends recently, and our daughter gave them a play-by-play of what we were going to do just over the weekend, And so I can only imagine at that teenage level the things that they start to share. So that's scary, but that is so important as far as making sure the children and the next generations are aware. Because once again, we talked about preserving legacies, and that's what we're doing in a lot of what we do for these families. So thank you so much, Yadira. This information has been so valuable. Thank you for giving us a look into the sophisticated world of risk management, which once again is different from just your traditional planning. So it's important to note that you are licensed in all 50 states, so you can help clients across the U.S. So if somebody wants to reassess their insurance, how can they connect with you?
Yeah, that's a great question. So easiest place to find me is on LinkedIn, Yadira Ansueto. You can also email me at yadira.ansueto@kns.com. And I'd be happy to start an insurance review for any client, talk to any advisor. I love collaborating with advisors. But if you just want a second opinion and want to talk about umbrella coverage for 10 minutes, call me. Yeah. I would love to do that. So.
Yeah, I know. You say insurance nerd, but you're just an insurance guru. You're an expert, and you love to talk about it, which is great. It means you're passionate about what you do. So for those of you watching or listening, whether you own a regular home or a small island, if today's information has inspired you to go back, it's important to look at your insurance, see how well are your assets protected. And we're going to continue our conversation on risk management. We're not going to talk about life insurance and how that fits into the risk management space. So thank you for joining us, and we'll see you in the next episode.
Thanks for listening. Don't forget to like and subscribe, and please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robinglen.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Robin Glen.